You're watching Masters in Trading Live with Jonathan Rose.
Where did that applause come from? Hello, everybody. This is Jonathan Rose, and welcome to Masters in Trading Live. At Masters in Trading Live, I get on here each day the market's open, go over the market, share some thoughts. Once in a while, we'll share our trade of the day. I've got everybody on the chat. Good morning, guys. Thank you for joining. Market is moving. It's Fed week. Last week, we talked a ton about the VVIX, VVIX. That's the VIX of the VIX. The VIX of the VIX traded all the way up to 135 last week. Lots of risk in the market. It's pulled back. I think it's like 95 right now. So volatility is coming out of the market, but it might be a little bit of a sucker's play because it's Fed week. So volatility comes out on Monday, but remember, we have volatility coming into the market later in the week. That's why volatility is coming out now, and we're not seeing the market rally. Today, we're going to be talking about the overall market. We're going to talk about the NASDAQ. I want to talk about something called a soft hedge. I shared a bunch of trades last week with all of you, and you probably didn't realize, but those were a soft hedge. What we mean by that, when markets pick up, when volatility picks up, it's really easy to go buy the Mag 7. It's really easy to go buy everything that's pulling back. But we don't want to do that. Instead, when volatility picks up, we want to find some ways to make some money trading volatility without adding a ton of risk to our overall long-term portfolio. When the market turns, your long-term portfolio will start doing much better. But when the market is coming down and volatility spikes, we want to do trades that are not going to consolidate your risk. We want to look for ways to make money when volatility pops. That's what we're going to be talking about today. I'm going to go over the screen right now. Thank you, everybody, for joining. Hey, Bill, Janet, what is up? Screen share. Here we go. Oh, I look good today. I like perfectly centered here. All right. Talking about the QQQs first. Volatility is coming out of the market. Okay. How do we know that? We know that because of our VVIX, which I'm going to get to right here on this top left. VVIX is trading 96.38. What I want to show you, though, is the NASDAQ. Let's look at the NASDAQ. Here we have the NASDAQ. Looking for key levels. The key level right now is if I put this on a weekly. We always want to look at weekly highs and weekly lows. Friends, the high of the NASDAQ, of the QQQs this week is 483.14. Last trade, 478. The high of last week, 483.97. We talk about our line in the sand. Our line in the sand is just one number that we want to say if it stays under, we're bearish, and it gets above, we're bullish. That one number, guys, right now is 483 in the NASDAQ, and that's going to be last week's low. 483. Hopefully that makes sense. It is a key level for all of us to watch. Right here, I'll put this up. These are our volatility visualizer. These are just our expected move bands. Right now, the QQQ is sitting outside of its expected move. It trades back in its expected move 91% of the time, but we need that NASDAQ to first take out our line in the sand of 483. That's what I have right here with the QQQs. Let's talk about a hedge. Okay, this word gets thrown around quite often. A hedge, an investment that is made with the intention of reducing the risk of adverse price movements in an asset. So I'll get to your question in a second. Actually, Saul is just saying 483 is what we're watching in the Qs. Yeah, 483 is what we're watching as our line in the sand. Above 483, we're going to turn to a little bit bullish. A hedge. A hedge, the reason for a hedge, it's insurance. Okay? It's why you're in Florida, you buy hurricane insurance. It's why you insure your car. It's protection. So right now, when volatility increases, when risk increases, we want to look for places to hedge. But you don't want to just get out of your long-term investments. Think of it like you're long the market. When the market goes up, volatility goes down because there's no risk to the upside. What we need to do is find a hedge that will protect our longer-term portfolio. That's why May 10th, March 10th, 0310, 0310, 0310, I shared 3 trades with all of you, with the promotional portfolio. The 3 trades that I shared are going to be in wheat, are going to be in platinum, and are going to be in silver. I want you to understand why I shared these trades. I shared these trades, guys, because they're going to be what's called that soft hedge. And a soft hedge is not going to be correlated with the overall market. So therefore, if the market turns, when the market turns, these are not going to be correlated. Everybody has enough risk right now in NVIDIA, in long-term holdings. What you want to do is survive. So right now, that's why we're sharing trades like wheat. Keep it simple. Buy wheat, 491. Why did we want to buy wheat? Wheat was outside of its expected move. It closes inside its expected move 75% of the time, but wheat is not going to be correlated to your overall portfolio. So if volatility continues to go higher, if the market continues to break, the price of wheat is not going to follow. The other trade that we also shared a trade in platinum. Same thinking as wheat. Platinum right now, here's platinum, is stupidly inexpensive to copper. Historically, it's very correlated to copper. So therefore, if the market keeps getting its butt whooped and keeps trading lower and vol keeps trading higher, the price of platinum is not going to be correlated to that. That's why we like to be long platinum. And then finally, one of my favorite positions right now is getting long silver. Gold continues to take out highs. Everybody's great trade idea is, hey, I got a great trade idea. Buy gold, buy gold. Well, everybody's telling you to buy gold. I think gold's going higher, but the best value is not to buy gold. It's to get your buns long silver, and that's what we did with our third position in PAS. So 3 trades shared last week with the free portfolio, wheat, platinum, and PAS. These are all going to be kind of like soft hedges for your portfolio that we can make money if the market goes up or if the market goes down. PAS, Dale Nice is up 11%. Just to show, PAS, Eric shared, great start to the week. Last week, 314. PAS, FCX, got on Prince, 46 dimes last week. Eric, I'm thrilled for you, my friend. James, PAS last week, PAS. He had some others. Nice one. Here's James again. Miller, yep, long PAS, still going up 26%. And then long PAS again. Most importantly for these positions, guys, it's not just to say, wow, we got some winners. More importantly, the thought is if the QQQs, if the NASDAQ, if the SPY, if the Russell continue to sell off, look for those soft hedges. Where can you make money regardless of where the market goes? In my very, very strong opinion, one of the best trades right now is to get long silver, stay long PAS. Okay? Hope that helps. What we always do right now is we move over to our all access portion of our portfolio. In our all access portfolio, we're going to go over what we call divergence trades. A divergence trade is just gold versus silver, like we're doing in the free portfolio, where I'm suggesting going long silver. Well, a divergence trade, you would actually buy silver and sell gold. We're going to go over some of our divergence trades that we have in our refiners. Thanks everybody for watching. We'll see you live tomorrow, 11 a.m. Eastern time. Everybody in all access, hang on. We'll be right back.